December 23rd, 2025, 11:42 p.m. Eastern. Something happened in October that almost nobody noticed. It didn't make headlines, it wasn't discussed on CNBC, and it certainly wasn't framed as a crisis. But in hindsight, it may go down as one of the most important industrial moves of this decade. Samsung Electronics quietly secured 100% of the silver output from a Mexican mine for the next 2 years. Not a portion, not an option, not a hedge, everything. And they paid just $7 million upfront to do it. Why would one of the largest technology companies on Earth lock up a tiny silver mine? Why now? And what does Samsung know about silver that the rest of the market clearly does not? Tonight, we break it down, because this is not just about silver. This is about AI, geopolitics, and the collapse of just-in-time supply chains. And the clock is ticking. Part 1. The move that raised red flags. Let's start with the fact. In October 2025, Samsung entered a financing agreement with La Perla, a primary silver mine in Mexico. The deal guarantees Samsung 100% of the mine's silver production for 24 months. This silver will not go to wholesalers. It will not go to refiners for the open market. It will not hit COMEX, LBMA, or Shanghai. It is spoken for. And here's the part that should stop you cold. La Perla is not a giant mine. Its output is modest by global standards, which raises the obvious question, why would Samsung bother? Why not simply buy silver on the open market like everyone else, unless they don't believe the open market will be there when they need it? Part 2, AI's non-negotiable dependence on silver. To understand Samsung's urgency, you have to understand something critical about AI hardware. AI is not just software, it is physical. And it generates enormous heat. The more powerful the chip, the more severe the thermal problem. Silver is not used because it is cheap. It is used because nothing else works. Silver has the highest thermal conductivity of any metal. That makes it indispensable in advanced chip interconnects, through silicon vias, high-density packaging, power distribution layers, thermal interface materials, server cooling assemblies. There is no viable substitute at scale. Copper fails under these conditions. Aluminum cannot dissipate heat fast enough. Graphene is not commercially scalable. Silver is not optional. And here's the number few people talk about. A single AI server rack can contain 50 to 200 grams of silver. Now multiply that by hyperscale data centers, national AI initiatives, defense systems, autonomous vehicles, edge computing infrastructure. The AI boom is a silver demand shock hiding in plain sight. Part 3. The demand curve. Nobody modeled. Now let's talk about the supply side. Global silver supply is already broken. For 5 consecutive years, demand has exceeded mine production. Silver is not like copper or iron. Roughly 70% of silver is produced as a byproduct of lead, zinc, and copper mining. That means even if silver prices double, production does not respond quickly. There are no silver-only megaprojects waiting on higher prices. So when AI demand enters the equation, it doesn't bend supply, it collides with it. Industry estimates suggest AI alone could consume 24 million ounces in 2026, 40 plus million ounces annually by the end of the decade. That is on top of solar panel demand. EV electrification, electronics, medical applications, jewelry, investment demand. There's no buffer, there's no stockpile, and there is no plan B. Part 4. Samsung's real problem, certainty. Now let's zoom in on Samsung. Samsung is building a $50 billion semiconductor fabrication facility in Taylor, Texas, scheduled to ramp production in late 2026. This fab will produce advanced AI chips for clients like Tesla, cloud provider Zen, defense contractors. For Samsung, a silver shortage is not a price problem. It is a shutdown problem. You cannot tell a $50 billion fab, sorry, silver prices are volatile. Check back next month. Production lines do not wait. A missed shipment doesn't reduce margins, it halts output. That is why the spot market is unacceptable. Spot markets offer price. Samsung needs guaranteed physical flow. So they did what industrial giants always do when markets fail. They vertically integrated. Part 5. The geopolitical layer. Most missed. There's another dimension here. China. China has already demonstrated its willingness to weaponize supply chains. Rare earths, gallium, germanium, graphite. Silver is next. China controls a massive share of silver refining and trade. Export licensing rules take effect January 1st, 2026. Samsung understands the risk, so this deal does something else. It moves silver sourcing to Mexico, a USMCA partner, a friendly jurisdiction, a closed-loop supply chain outside Chinese control. This is the rare earths playbook all over again. But this time, Samsung moved first. Part 6. The canary in the coal mine. Here is the key insight. Samsung does not speculate. Samsung does not panic buy. Samsung does not chase narratives. They plan years ahead. Which means this deal is not about October 2025. It's about what Samsung expects in 2026 and beyond. And here's the most important implication. Every ounce Samsung secured is an ounce that will never reach the public market. As other companies wake up, Tesla, Apple, Nvidia, defense contractors, they will not compete on price, they will compete on access. That is when markets break. Part 7, historical context. Why this time is different. We've seen silver spikes before. Those were speculative episodes. This is not. Then, pressure came from leveraged investors, concentrated positions. Financial demand today, pressure comes from industrial necessity, state policy, infrastructure build-out. You cannot margin call an AI data center. You cannot legislate silver into existence. And you cannot pause the AI arms race. That's why this time is different. Part 8, the end of just-in-time. For decades, industry relied on just-in-time delivery, minimal inventories, maximum efficiency. That system collapses when supply becomes strategic. Samsung just told the world, just-in-time is dead. Strategic stockpiling is back, and silver is now a critical input, not a commodity. Part 9, price scenarios, context, not hype. Let's talk price, not predictions, scenarios. Base case, $120. This assumes managed stress, no delivery failures, gradual industrial hoarding. Even here, silver must reprice to reflect scarcity. Stress case, $150, $200. If AI demand accelerates and inventory tightens, price must ration demand. This is where shortages end. Crisis. Case, 300 plus. If multiple tech giants lock supply simultaneously, spot markets cease functioning. Price discovery becomes violent. This has precedent. Palladium, 2022. Part 10, risks and reality check. Let's be absolutely clear. This will not be smooth. Markets under structural stress never move in straight lines. There will be sharp pullbacks, sudden drops designed to shake confidence. There will be violent volatility, moves that feel irrational in the moment, and there will be attempts to regain control through the paper market. That is how stressed systems defend themselves. When supply is tight and demand is non-negotiable, price suppression becomes a reflex, not a solution. We have seen this playbook before. Sudden overnight sell-offs, heavy futures dumping during low liquidity hours, narrative management through overbought headlines, claims of substitution that don't exist in reality. But here's the critical point most people miss. Volatility is not weakness. Volatility is the market signaling stress fractures beneath the surface. Stable markets don't swing wildly. Balanced markets don't gap unexpectedly. Healthy markets don't require constant intervention. And when price begins to lurch, snap back, and overshoot, it tells you something fundamental. The system is struggling to reconcile finite physical supply with infinite financial claims, and that struggle is intensifying. Part 11, what this means for investors. This is not a trading environment. This is a positioning environment. When markets face structural breaks, how you're exposed matters more than when you entered. There are 3 broad categories of exposure. 1, physical silver. Physical silver does one thing exceptionally well. It removes counterparty risk, no clearinghouse, no settlement window, no promise of future delivery. It is not dependent on trust in an intermediary. That matters when supply chains tighten and paper claims multiply. Physical does not guarantee short-term gains. It does not protect against volatility, but it protects against non-delivery, which is a different risk entirely. 2, primary silver miners. Primary silver mining companies offer leverage to rising prices. Their costs are relatively fixed. Their revenues are price sensitive. When silver rises, margins expand, cash flow accelerates, valuations reprice rapidly, but mining stocks come with risks, operational disruptions, jurisdictional exposure, equity market volatility. They are not substitutes for physical metal. They are expressions of the same thesis, amplified. 3, paper instruments. ETFs, futures, swaps, and unallocated accounts rely on one thing: settlement trust. They assume metal will be available when demanded. They assume delivery rules won't change. They assume cash settlement won't replace physical delivery. Most of the time, that trust holds. But in structural shortages, settlement becomes a variable, not a certainty. That doesn't mean paper instruments are bad. It means their risk profile changes under stress. Understanding that distinction is critical. This is not about upside chasing. It is about knowing where your exposure actually lives when systems are strained. Part 12. Final reality. Check. This must be said clearly. This is not financial advice. This is an analysis of industrial supply chains under visible stress. Markets rarely announce turning points with fanfare. They don't issue press releases saying, "Attention, structural failure approaching." They do something else. They signal quietly. Through unusual procurement deals, vertical integration, strategic stockpiling, inventory drawdowns, sudden volatility, behavior that no longer matches narratives. And then, when enough people realize what's happening, they move violently. By the time the story becomes obvious, positioning is no longer optional. It's expensive. Conclusion. The AI revolution has a physical bottleneck. Samsung didn't issue a warning. They didn't hold a press conference. They didn't publish a white paper. They simply acted. And in doing so, they told the market something important without saying a word. The future of AI is physical. It runs on atoms, not code. And one of those atoms is silver. Silver is not abundant. Silver is not easily replaced. And silver production cannot scale on demand. Those who secure supply early gain certainty. Those who delay face volatility. Those who wait too long may find there's no supply at all, at any price. This is how critical resource transitions begin. Quietly, strategically, before the headlines arrive. If this analysis helped you connect dots others are missing, like the video, share it with someone who needs to see it. Subscribe to stay ahead of what's unfolding. Because this story is not finished, it is accelerating. And when supply chains finally snap under pressure, they don't wait for permission.